Try this. Oh, test it?
Test 1, 2, 3. We're back on anyway.
Don't talk for a second. Test. I think I might have fixed it.
Okay. All right, gang, welcome back to the True Wealth Radio Show, where if you were just joining us, we got the live stream on YouTube. This will also be available via podcast tomorrow. You go to littlejohnfs.com and look under the, what is it, the resource tab. There's something like that, but we the Knowledge Center.
The Dave's Amazing tab?
We don't have that tab for good reason.
What?
But anyway, it's available there. But you can also subscribe to the YouTube channel and you get notification when we go live, and you can check these out later. So, Matt, I have a question for you. It's sort of academic. It's a little bit wonky, but I think it's super relevant for anybody that's an investor right now.
Yeah.
Even if you're like, no, I just have a 401k plan, or I'm at working and I've got PERS or something like that. Mm-hmm. Okay. The question is, will indexes continue to be a good proxy for the market?
I'll just go out on a limb and say, sure, under the premise that I do think it's going to get super tech weighted, right? And I think that's going to continue to kind of dominate the space. But I'm going to look at where are earnings and revenue really coming from, and how are people making money? Well, if if AI does manage to eat some of the jobs that it's projected to eat, you could see companies continue to shift to a more, tech-based platform. And so it's like, well, what is the market in the future? What if the market is just technology? Like, what if you see like your standard, run-of-the-mill companies kind of disappear and all that's left is tech?
Matt saw me sort of light up and smile as soon as he said that. You hit the crux of the question. What is the market?
Mm-hmm. It's right? The market. It's wherever the money is.
So
where the corporate earnings are. That's where the market is.
Well, that's one of the reasons that it's difficult to outperform something like the S&P 500 on a long-term basis is it biases to
whatever's
the biggest
winning.
Companies that are getting bigger.
Yeah.
But not only that, you now have all of these institutions that invest automatically into these indexes. And so if you're on that list, then that means that all of the new money flow from people that are putting money into their retirement plans sort of automatically shows up. Well, and in an auction, right, if there's more buyers than sellers, the price goes up.
Well, and that's what we
call a bid.
Yeah.
We're putting a bid in the market.
You're right. Where the money is moving inside the market kind of dictates some of that. And look at like what the Treasury just did with all of these Trump accounts for kids. Right? All these kids getting $1,000 a piece. Where is it going? The SPYM. It's going into a version of the S&P 500, right? And so
there you go.
Yeah. And you're not wrong to
all
make
of
that
this
point.
That's interesting is, what is the market? Well, it may not be a diversified snapshot in the future.
Which I don't even think it is now.
I agree. While it owns a lot of things, I think that it's got some real concentration bias.
Think about this. We just watched literally memory and semiconductors. Just two subsectors moved the entire market lower when virtually the rest of the market was going up. So I'm like, you can already, I think, make the case that it's way over-biased in one direction.
Mm-hmm.
Two subsectors moved the entire market lower when the rest of the market virtually was going up.
Well, this is why the concept of what is the market, and and as investors, it's like, hey, look, I'm more concerned about what is it that you own. This, I think, is relevant for some of the rest of the conversation that we want to build today around.
I do
rules.
too, because how many times have you seen someone they're not even as diversified as an index. They pick a handful of, I've seen it, a portfolio with 3 positions in it. Mm-hmm. Or less. I've seen them with one position.
I've seen Jim Cramer play the game of am I diversified with a 5-position portfolio. And I just think,
you know what's crazy though? Like, do you think, this is just a random question, if you really put your heart and soul into it, could you make a 5-position portfolio more diversified than an index? Like the NASDAQ 100?
Ooh.
See where I'm going with that?
Yeah.
Like,
so
if you wanted to,
you could make it academically, like sector-wise.
Right?
I think you could.
Yeah.
I think that the problem is that you do not have enough diversification to mitigate non-system risk. Okay,
I would
what
agree
we
with
call
that.
idiosyncratic risk. It's a
Sure.
fancy term, right? But idiosyncratic risk, to the layman, because remember, if I make the words complicated, they cost more, right? So let's call it idiosyncratic risk, and then we can charge a lot. But if I tell you what it means, it just means, hey, it's the individual or unique risks of each company. So what happens, I've used this example, I don't know how many times on the show, but Home Depot, their CEO dies in a plane crash. Okay, that's Home Depot's problem. That's not the stock market's problem.
Right.
And so you do still bear a concentration risk that something could go wrong with your single holding. You're very concentrated even though you have 5 positions. You could make, I could probably rattle off a 5-position portfolio right now that's pretty broadly diversified. Different sectors, they don't overlap a lot. They have very low correlation to
Right.
each other. That's they have adequate liquidity for trading. Like I could probably create that. I'm pulling it out of my hip pocket.
Yeah.
The problem is that doesn't make it safe.
Correct.
And even that, air quotes around safe, that is so concentrated that the problem is if you miss even one,
Right. One company
right, one
goes
company
completely under.
can completely cannibalize the returns of the entire strategy.
Yeah. But
So-
we know people that are 1-position people or
Yeah.
5-position people.
I know people that just have like a savings account and gold stashed away.
Yeah.
And you're like, wait a second. So other than the physical assets that you own, like your car, your house, that kind of
Yeah.
stuff, there's no diversification at all.
Yeah.
Okay. I mean, it happens.
It works when it works until it doesn't. And that's the problem. Like, what if it doesn't work? Because how many people would have thought back in, when did AT&T crest out at the number 1, largest position
I
in
don't
the S&P?
remember.
You know what I mean?
Yeah.
But, someone, I bet you someone or maybe
How
a
about
handful
this?
of people
Elon Musk. Okay. Elon Musk was PayPal into Tesla into SpaceX. Everything else is privately held. Mm-hmm. And you're like, well, if I put 100% of my eggs in those baskets in that sequence, that worked out pretty well.
Yeah.
So, now he's done a bunch of other things because they are his companies, but they're companies that went public. And now they're publicly owned companies, and he just happens to be a majority shares holder.
But timing's a lot of it too. What if you would have
yeah.
what if you would have put 20% of your money in PayPal 2 years ago before it dropped 50% or whatever it was, or you put in, we saw the report of that guy that put all his money in SpaceX, and now it's 20% below its IPO, and so it's like, gosh, people are really gutsy.
Somebody uses, I know what it means, but not because I'm cool. I know what it means because I have kids. When people said, folks that ran out to buy SpaceX got thirsty. Mm-hmm. And I was like, what?
Yeah.
And then I had to go, oh, I get it.
Yeah.
I'm aging out for sure, but it was a thirst trap,
It
right?
was.
I just, I got baited into it. I had to be there, had to be part of it.
Well, you didn't.
I did not.
You go back and watch the show stuff, and there was some warnings on that one,
Yeah,
and it
I was-
actually is kind of played out just like we said it would.
Yeah, I was really it's getting much more into valuation levels that you say this is still risky, but at least the numbers you think maybe it could grow over the next 3, 4, 5 years, get some government contracts and get some cash flow moving, that those valuations could ultimately make sense. But early on, I'm like, this thing was priced beyond perfection. Mm-hmm. And with the benefit of hindsight, it's easy to say that.
Well-
It's just kind of interesting because we kind of we said it, right?
Well-
And we didn't say it as a recommendation. I just said, I'm not going to touch it because it just seems radioactive right now, and I can't value it.
Didn't its valuation grow past being like the value of Amazon or something?
Oh no, that was huge. It was huge.
And I'm like,
maybe
what?
it was past Amazon.
Yeah.
but I know that
It was 2-point-something trillion at one
it
point.
was a multi-trillion-dollar company in the first week,
That's mind blowing.
and you just thought, what? And if you went out and bought it, you probably
We haven't
kicking
e-
yourself.
I don't even think we've had our first earnings report. I think that's here in 2 weeks.
Yeah.
You know what I mean? It's like,
Yeah, we
what-
don't know how
It's
to-
kind of like this black box. What do you earn? How much do you make? What do sales look like?
It was really built around.
And then people were like, "We don't care. Buy it."
I said this. I say this about Tesla now. I've been on air before saying I don't know how to value Tesla and it looks expensive. The thing is, I'm not sure what Tesla does. I know things Tesla does, but I don't know what Tesla is going to be when it grows up.
Right. 'Cause
Tesla
it's
was.
like, is it a car company? Is it a robotics company? Is
well,
it a
that's
solar
the pivot.
company?
First, it was a car company.
Yeah.
Then it became a battery company. Then it became a solar company. Then it became a battery company again. Then it became a car company again. And then it became a robot company.
Hey, maybe that's how you make a bunch of money. Just always confuse people. How do
Well,
they make money?
I mean, I don't want to turn this into a trash Elon Musk. That's not what's going on, because I think there's still amazing things that you go like, well, look at the product. It's pretty incredible. So this is not trashing one way or the other, but it is saying it's very hard as an investor to know what you're investing in when you keep changing the story. Mm-hmm. And because of that history, it's like I'm a little cautious here, because you have SpaceX merged with XAI. And I'm like, wait a second here. So Grok,
Did you hear what they're doing
It's
with
running
the
it-
banking thing, by the way?
no, with what?
With the banking. X is adding banking.
Well, that's been on Elon's for years. I mean,
Yeah,
I read his biography.
I guess
that
it's
was
like-
written like 10, years ago, and
Yeah.
that was something he was talking about since his PayPal days. He originally wanted PayPal. He wanted it to be named X, and he wanted it to be that back then. So, all of these things have been sort of linked together for years. In the same way, the case that Tesla making robots, electric vehicles, and batteries, and the Boring Company makes tunnels. It's like, well, that's all the stuff you need to colonize Mars. Like, that really does connect together. You need the AI systems, you need the robotics, you need the battery and power storage, you need power generation, and you're going to be subterranean because there's no atmosphere on Mars. So you're going to have to build stuff underground in order to transport things around. And you can set up bubbles and domes, but you're going to have a lot of underground boring that's needed.
Do you
to be
think
on Mars.
that he's wild enough that that's actually just his play?
Well, I think that is probably his play. The question is, does he realistically think it's going to get there in his lifetime, or is he just making incremental steps that way, and he's making profits?
So
as he
what
goes?
would be the driving force? Like, why would you work 18 hours a day, 7 days a week to just put people on another planet?
So
Do you have a theory for that? Because I've asked myself that before.
it's
I'm
an
like,
unsatisfying theory, but I do.
really?
Yeah.
Okay.
Okay. I'm gonna try to say this was diplomacy, because I don't want people to snap at me for this and say I'm not being sensitive or whatever. I think that he is on the spectrum somewhere, and that's just kind of driven into his DNA. And I think when you hear his backstory and some of the things that he was surrounded with, there was a lot of, candidly, he described in his biography, there were elements that were pretty abusive in his backstory. And so the commentary is that he's all signal and no noise.
So do you think he's like trying to make a world that he can control, and it's his own little
No,
space
I
of
don't
perfection?
want to go down the rabbit hole of that much psychology. I don't think that's what it is. I
Okay.
think it's more the idea that he became ultra focused on goals because those were things that made sense to him. People don't make a whole lot of sense, and so they tend to be more like utilities in his plan than relationships. And
Okay.
so if you have a person that really wants to accomplish a mission and doesn't see people as a relationship with value, but instead sees them as, well,
Like a
relationships are
transaction.
useful if I can keep you engaged on my project. But otherwise, I can kind of run through different, how many kids does he have with different women? It's like, well, that tells you something about how he bonds with people, in my opinion, right? So there you go. It's not super popular, but it's like, yeah, he's probably a little bit on the spectrum. He's got crazy amounts of resources. He's radically focused on what he wants to do, and he doesn't really care if he hurts people's feelings. There you go.
Yeah, that's fair.
So, yeah, I don't know how we got off on that rabbit trail, but welcome to the True Wealth Show. We do this sometimes. Let's do this.
What
Let's
were we
regroup.
talking
Let's
about?
take a break. We'll come back and we'll regroup.
All right.
And when we do, we'll actually talk about what we intended to talk about.
Okay.
Maybe. Stick around. I'm Dave Littlejohn.
And Matt Dixon.
You got True Wealth on News Radio 93.9 FM and 1240 KQEN.
Yeah, we got deep off into the wilderness.
Well, it's weird because I admire what Elon Musk has accomplished. It's just And like some of the stuff with Doge, things like that, I thought it was genuinely fascinating. It's hard to tell if Elon Musk is really trying to do something noble and save the country through the lens that he thinks he has influence over, or if he's a supervillain.
It's really hard to tell. It really is.
Well, I mean, people
Like,
say
I
that
mean-
about us. Are like, are we really financial advisors that are trying to do things for the good of our customers, or are we self-serving?
Yeah.
And, so we talked about this at lunch. The trick is, since it's really hard to just go like, trust me, right? What you try to do is align all of the things so that they can both be true at the same time. Right?
Okay.
If taking care of our clients really well ends up benefiting us too, that's great alignment. So it's not like you either benefit or your clients benefit. It's like, no, we benefit when we do this right.
Plot
Now, it makes it harder to look at through the lens of like, well, how are you trying to screw people over?
Plot twist. You ready for plot twist?
Plot twists away.
So Elon wants a bunch of kids because he actually plans to colonize Mars with only the people that he deems like pure in a sense, right? So he takes his family to reproduce on Mars, and while he's there, he flips a switch on all the robots because everyone has a robot, and he watches from space with his satellites, like a TV series, humans fighting against his robots for who can survive on Earth while he sits back in his chair with all of his...
So he makes Thunderdome on Mars between people and robots.
Yeah.
Golly.
How about that? How about them apples? You didn't see it coming, did
I don't even
you?
know what to say. I have heard it's more like, well, we should be populating the world with intelligent people. So he's like, I may as well cast a broad net. It's more like arrogant, like I'm smart, so I may as well just let all these women.
You never thought
carry
about my
children.
perspective, did you, until just now?
I'm
And then
still
it
trying
all
not to be
it
honest.
all it all clicked. You're like,
you're going, this would make a hell of a UFC match. Like,
dude, why do you think
robots
you're like,
versus
yeah, Dana White buys a ticket up there, and they're just up on Mars
jeez.
watching
Like-
the...
And SpaceX sells the tourist tickets to get up and watch in the weightless stadiums.
You're onto something. Yeah. All right. How do we keep developing this plot? Keep it like add some more cornstarch. Thicken this thing up a little bit.
I don't know. No, you know what's worse? I can think in the plot, but
You want
Why?
to too.
Why?
You want to, and
sci-fi
you can't.
just keeps rolling. It's like, and before you know it, we created our own miniseries.
Dude, we're gonna have to sell this to like NBC or something. They're gonna.
They can't be buying anything right now. The writers are trying to keep AI out of the game.
Dude, we'll work for less.
Yep, here we go.
We'll take a pay cut. We'll write for NBC.
We're not. Stop it. Just stop it. Welcome back to the True Wealth Radio Show. Dave Littlejohn in studio with
The guy that keeps running him off the road.
we are. Yeah, Matt. Thank you for.
You're welcome.
I don't even know. If you catch the
The raw
podcast,
Yeah.
it's probably clipped actually. If you go watch the video,
I'm just
the
asking Emma right
segments
now.
in
Don't
between
clip
might
that.
be the gold this time.
Don't
So
clip the edits out.
he's all like, you know what we need to do? We got a sci-fi movie on the making here, and it's gonna go viral. So
Yeah, if
oh
you want
boy.
to hear my thoughts on Elon Musk, just call the office at 541-375-0898, and I'll give you one to wrap your brain around.
Okay, this is the Matthew sagas. To be continued. Meanwhile, let's try to kind of hook this back in for all of our listeners that might want to figure out if this can help them at all as investors.
Okay.
So we talked about how indexes have become concentrated in some sectors, and that concentration can actually become a source of volatility. So
It can.
this, by the way, academically is one of the challenges is sometimes an investor may believe that they're diversified, but they're not very effectively diversified. And our example of the concentration in the index is in an index. I shouldn't say the index, because not all indexes behave the same way. In this case, we were talking about the NASDAQ.
Right.
S&P 500 has been similar.
Like the
though.
Dow, very different.
The Dow
results.
has not suffered the same way.
No.
It's more broadly and evenly weighted across sectors, so it didn't have the same concentration bias. So let's talk for just a moment about the concept of diversification. I've given this lecture before so much that I named it. I call it Mind Your Shuns. Mm-hmm. Right? Diversification, correlation, allocation. This is a three-legged stool. All of them need to be part of this, or it doesn't really hold itself up. Okay,
Yeah.
so first, what's diversification?
I mean, we kind of touched on that one earlier, where it's just like you have assets that don't all walk and talk the same at the same time.
Yeah, it's putting your eggs not in one basket, right? You
Yeah.
don't just own a single position, you own a bunch of positions. But we just talked about how if you own a bunch of positions that are all in the same industry or sector, you're not terribly diversified from a market perspective, not
Yeah.
marketing, but a market perspective.
Yeah.
Okay, so we have two other legs of the stool. We have allocation and correlation. Mm-hmm. Let's talk about allocation next.
Okay.
What does that mean?
I mean, where you're allocating your money is like
Yeah,
where you're putting
it's
it.
the categories,
Yeah.
right? Are you going into stocks or bonds? Are you going into international? Are you going into big companies, small companies? Are you diversified across sectors? It's where are the areas that you're investing in, or the categories.
Mm-hmm.
Okay, so you've got the individual positions, you can be diversified there, but we need to also try to be diversified properly for the amount of risk you're willing to take through allocation process. What about correlation? This to me is the one that's really important, and it's talked about in the professional circles,
Yeah.
but just not in the retail circles.
Well, I bought Exxon, Chevron, and ConocoPhillips, and XLE, so I'm in energy alone.
Yeah. So what have you just described for our listeners?
Concentration.
Concentration.
Yep.
And correlation means everything's related to itself.
Yep.
Right? Well, sometimes we use this correlation concept. Maybe you've heard causation and correlation aren't the same thing. That's the idea that we sometimes get data and we say, well, when this thing happens, we see this other thing happen at the same time. Does that mean that, here's a real life example. If people don't sleep enough, then we see more car accidents. Mm-hmm. Okay, that's an example of a correlation between the amount of sleep and car accidents. And interestingly enough, causation as well. That, well, the lack of sleep, we know medically can slow your reaction time and so forth, and so that can cause more accidents. Those are actually the same thing. But you can have two events that appear to be correlated, and these are weird things. Like whoever wins the Super Bowl determines whether or not the S&P 500 index will be positive for the next year. Well, there's actually a fair amount of correlation to that index, so much so that it exists. But do we really believe that the winner of the Super Bowl affects all of the earnings of all the different companies and influences everybody for the rest of the year as to which positions they buy or don't buy?
No.
It's probably not causation, but the correlation exists. Well, why am I beating this drum so much? We've used the example of if you buy Home Depot and Lowe's, you are technically diversified amongst two companies, but they're highly correlated to each other, really similar businesses.
Yeah.
And so you can either have direct correlation, one step together. You can have inverse correlation, one step one direction, the other goes a step the opposite direction. Or you can have low correlation, which means one of them steps and the other one may or may not step. And that's what you're really looking for. The whole idea, when we talked about 5-position portfolio, the concentration's a problem. Because
Right.
even if you're diversified and even if you're low correlation, you're still not well diversified from a market risk. But if you have 25 or so positions and you start looking at what that means, if you have 25 low correlation positions, your standard deviation or the variability of your investment mix is statistically almost the same. Not technically the same, but almost the same as if you owned 1,000 positions.
Isn't that crazy?
Yeah. So you can get more and more diversified, but you don't necessarily become lower and lower risk beyond a point, because mathematically, you really have diversified a lot of the risk out of your portfolio.
That makes sense.
So this is now diversified the idiosyncratic risk. Remember, we talked about that, because I can't help you if we have a world war, all the markets get affected. Right, that's not something that diversification helps. Everything gets hit. And so one of them is the idea that the tide rises and falls, and all the boats go up and down with the tide.
Yeah.
That's the whole system.
So what's kind of inside of that wrapper that you just described? You know, we've been hitting on these ideas of different blind beliefs, things that people kind of blindly believe.
One of them is that the index, they're diversified.
Okay.
And they are mathematically owning a lot of positions. They're diversified. But they may still have a lot of sector concentration. And it appears that that concentration has been increasing over the last several years as the AI trade has ballooned a handful of really large players. They're now referred, we've named them, by the way, we've named them hyperscalers.
Yep.
And so these companies like Apple and NVIDIA that have become super, super huge.
Right.
And those hyperscale companies have become disproportionately large within the weighting of their respective indexes.
Yeah.
So
They have gotten really, really big. And I think that, you know, one of the segments we were going to kind of talk about today was like this belief that people have that the biggest winners, that in the companies that are kind of creating the technology, they're going to be the ones that capture all the profits. Right? And you brought up this theory of like, well, yeah, like they can, but where are they going to get all their energy from, right? And that was a really valid point that you were talking about. It's like, yeah, there can be some big winners, but they might not be the obvious ones.
Yeah, and it's interesting because this is a form of analysis that's a little bit difficult because it involves thinking several chess moves
Down the line,
Down
yeah.
line. So, well, I mean, maybe we just take the break here. We come back and we talk about this idea of how do we do?
Yeah, how do we
All right.
identify this? How do we
Stick
walk through
around.
it?
We want to talk about thesis-based investing, or maybe a better way to put it is, what could go wrong?
Sure. There we go. I like it.
Stick around. We'll be right back. I'm Dave Littlejohn.
And Matt Dixon.
And you got True Wealth on News Radio 93.9 FM and 1240 KQEN.
Okay.
I think.
Oh, it's getting hot in
It
here.
is hot in here.
Ooh, I am like sweating.
And my hair is too long. Just so we're clear.
You need to grow it out all the way to your shoulders.
So, you know, my wife wants, or has encouraged, she's not, maybe not want, but she's like, grow it out. She likes the hair longer.
You should do it.
I feel like this is a poll waiting to happen. Is you should chime in the comments if you're seeing this on YouTube. Do I keep growing my hair out? What could go wrong? But it's driving me nuts. It's the longest my hair's probably ever been in my life, and I just feel like, oh, the back of my hair is so long. I'm gonna be able to do like a ponytail before long, and that's weird. Could I go to your barber, Matt?
You can't. It'll cost you nothing.
Oh, well, actually, my Alex, my regular barber, I don't know if he'd be okay with me two-timing behind his back.
I know that Matt Wright is going to be in Portland.
The what?
You know the comedian, Matt Wright?
Oh, really?
He's going to be in Portland. Tickets out.
Fun.
Terrain where giraffes stroll past your window, zebras graze just feet away. It's an African-style adventure right here in Winston.
When's the last time you went to a concert?
To get even closer, upgrade your visit with unforgettable
I don't remember.
factors like feeding
Really?
a panda
You're
and
not much of a
or
concert
eating
goer?
lion. Adventure is
No,
closer than
probably-
You can see anyone in concert right now. They still have to be alive. Can't be someone that's dead or the band has been dismantled. Who would you see?
I'm not sure.
This week, it's a little girl with
I'm really not.
shreds of guitar.
Yeah, I know that my wife could probably blurt out an answer. She would like to see, if she had an opportunity to see Taylor Swift in concert, she'd go, but also Bruno Mars. And I do think Bruno Mars should be pretty fun. He's a heck of an entertainer, and he's talented. So I think that would be a good. Honestly, I think Taylor Swift probably does a great concert. She's just not my flavor. Yeah.
Good old girl bands.
Okay. All right, gang. Welcome back to the home stretch of the True Wealth Radio Show. Matthew,
Yes.
I feel like when I use your full name like that, you're about to get in trouble.
Oh boy.
That, or you're about to get some kind of weighted question.
I'm ready for the heavy question of the day.
Well, when we sort of left off, we were talking about the concentration, the way we build portfolios, and then I got to actually remember, what were we going to talk about?
We were going to talk about how some of the big winners might not always be the obvious ones, because right now, and this is how I feel the market went. Everyone just honed in on semiconductors, chips. And when they heard of AI, it's like, well, chips. And then the conversation ended there. Well, where are the chips going? What infrastructure are they building?
Okay,
How are
it's the
they?
thesis-based investing thing.
Yeah. So
I really need to carry in a notepad. I'm starting to lose
here,
it.
do you want my pen? I got you.
Technically, but I have to write it on my hand.
Can I write it on your forehead?
Whew,
Semiconductors.
You can see it, but I can't.
Semiconductors.
Yeah. So we
Why might that not be the obvious path?
Well, so here was where this started. You asked the question, what would need to be true for these numbers to make sense?
And for the market to just keep cooking with the same temperature?
Sort of. I mean,
Yeah.
I looked at some of these companies and I look at their earnings expectations. And one of the ways that you can do this is you can look at the price to earnings ratio. So you say, well, how much is the company actually earning? How much stock is in existence? And then you divide the amount of stock by the amount of earnings, and you get a ratio.
We've heard of PE a lot on this show. We don't typically talk about forward PE, though, and that was something that you were diving into today.
Yeah.
Do you want to talk about how that might be a little bit different?
Well, forward PE is the guidance that the company is issuing. These are the expected profits. So based on profit expectations and the projection of profits, this is where the PE would be today.
So, say a company has a current PE ratio of 20, but a forward PE of 16.
Then you're actually expecting that the company could continue to grow a little bit if you expect the PE to remain at about 20. Strangely enough, right? What you're saying is the future PE is actually lower because if we include the growth that we expect, it's not as expensive.
The price is stagnant, kind of, in that equation, but the earnings go up. So the ratio is lower.
Well, yes.
Yeah.
And so, but what happens in actuality is now, let's say the projection is for 90 days later, for the next quarter.
Okay.
And as the company continues to engage in business and analysts continue to assess whether or not the company is likely to hit those earnings, and they do that by looking at contracts and the performance of other companies and where their earnings are showing up and so forth, to get an idea whether or not the company's going to be right on their projection. If they expect the company to be right on the projection, and the market thinks that the value was proper when it was a 20 PE ratio with the last one, then you would expect the price to start climbing.
Exactly.
For the ratios to sort of equalize to what the former ratio had been.
Correct.
So now the opposite would occur if forward PE was higher than present PE. Then you actually say that's a problem. We think this is overvalued and it's probably going to have to come down some. So it's one of the ways that you can establish guidance. And by the way, just because those numbers are out of alignment doesn't make them, that does not compel an investor's behavior.
Correct.
It just informs it. Right? And then the investor's going to make the decision that they're going to make. And so supply and demand will ultimately drive the price of the stock. But that's one way to get a sense of the leanings of the marketplace, is how the forward earnings are compared to present. So let's suppose that you have much lower forward earnings, then there's an expectation of really high profits. Well, if that's the case, then you have to say, well, what does the company need to do for those profits to be possible? And the game that Matt and I were playing is it really possible for some of these companies to hit their targets? And the question is, well, maybe yes, but is it possible for them to do it with the techniques that we know?
or with the amount of energy per se that.
Well, that's and I'm headed to that, Pat, because there could just be creative financing where they conjure profits somehow. I mean, these companies all seem to be doing deals with each other, so it's a little hard to say, like, well, I had a big contract with you, and next quarter you have a big contract with me. Are we just trading the money back and forth?
Right.
We're just trading credit with each other. That's some accounting stuff that you got to get into the layers, into the weeds to figure that out. But I think a simple way to look at this is, how much power does it take to produce the amount of computational need that these companies say that they're going to be pushing?
This was an interesting quote here. So during a gold rush, the biggest winner isn't always the person searching for the gold. Sometimes it's the person solving the problem every gold miner has. Right? So, like, are you the one with the store that is selling the picks and the shovels and the sluice box? Like, are you the one that's selling the stuff to the gold person going to find the gold? You don't necessarily have to be the one that pulls it out of the ground in order to make profits.
Yeah, you could sell pickaxes
That's
and do really well, and nobody ever gets gold.
Mm-hmm.
I think that's the issue right now. Let me just summarize this for our listeners without this being investment advice of any kind, but just a really interesting moment for the AI boom that we're in. Unless we come up with a way to get a lot more efficient processors in the marketplace that require a lot less energy, it doesn't look like there's an adequate source of power to actually do all of the AI computing that is supposed to replace all the jobs out there.
Mm-hmm.
And there are second order effects to this as well. There may not be adequate water to cool all of the data centers that are being allegedly created for this. So there are some physical impediments to making this happen right now. Doesn't mean they're not solvable, but with the known technology and the known production capacity and the backlog from all of the different subcontractors and suppliers needed to create power for all these places, it's questionable as to whether or not the companies can deliver on the promise of this massive AI computing.
Right.
And so that's the concern that analysts are starting to tiptoe around is we've made some really huge promises and the market is really expecting these promises to be delivered upon.
I think that might be why we've seen some of the sell-off that we've seen, right? We haven't really seen it fully on an index level, but...
And isn't it interesting it was the chips first?
Mm-hmm.
Right? Wait a second. Why would we be buying all these chips if we can't put them into service?
Right. And so the first thing to boom is now kind of the first thing, it seems like, to kind of sell off.
And it has sold off. We've seen chip suppliers anywhere from 20 to 50% off of their peak values. I'm not naming names, but they're out there.
Sure.
So
it's just raising questions, and I think it's smart for investors to be aware of the trends that are going on because, like you said, if the index can pull back off of just one subsector.
Well, and here's the other thing. I've heard it said many times. Markets can remain irrational longer than you can remain solvent.
Yeah.
This thing could keep going longer than we expect.
Yeah, because we've gotten used to these little flash crashes. Oh, the market's down 20% for 3 months. Oh, it's back.
We've also gotten used to...
We've gotten kind of comfortable, haven't we?
Well, there's strange things like we haven't seen the whole market at large have corrections, but we've seen the corrections roll through sectors at a time.
Mm-hmm.
So pieces of the market pull back when other pieces stay higher. And so that's really interesting that we're not seeing this sort of broad market pullbacks. I think the last really broad market pullback we experienced was probably in 22.
Yeah.
And so, I don't know. I'm certainly not asking for it to happen.
Right.
And I'm not, running through the streets saying the British are coming. I'm not saying it's inevitable. But I think we need to be aware that markets don't die because of old age, but they can, they say bull markets don't die of old age, but something typically kills them. So just be aware.
That's funny.
Yeah.
Okay, so if there's an investor that's listening to this and they're like, Dave, Matt, I've been listening to you guys for far too long. Can we actually get the ball rolling on figuring this stuff out for me? How do they get a hold of us? What do they do?
Yeah, they can give us a call, 541-375-0898. You can also email to info@littlejohnfs.com. You can text that number I just gave you. There are all different ways to reach us, and we would be happy to sit down and do a free consult and we can get the ball rolling or not, but we can certainly get you more information. Side note and a reminder, mark your calendars, gang. On August 20th, we're going to be doing a workshop at our office around will and estate planning. So if you got questions about whether or not you should be putting a will in place or an estate plan, you need to get a trust, need updates, that's also on the calendar. So that's coming up August 20th. So,
I like it.
all right, well, I can see that we're out of time for now. So just the last reminder for everybody, the number again, 541-375-0898. Matthew, anything else for the go to the order?
No, give us a call. We'll
right.
help you out. All right.
And then until next time, I'm Dave Littlejohn.
And Matt Dixon.
And you've been listening to True Wealth on News Radio 93.9 FM and 1240 KQEN.
Whoa, just in time.
Did it. Whew.
Less than a minute.
Yes.